James Thom, investment manager with Aberdeen Asset Management, joins us live from Singapore. James, fantastic to have you back on ET Now. Thank you for joining us. James, as a house, Aberdeen has been extremely bullish on Indian equities. You are a big believer of the India growth story. But given the kind of macros we are working with, the kind of economic environment we are staring at, have you changed your India opinion, or you are as bullish as ever?
Good morning, and yes, nice to be back. I think, if anything, we're as bullish as ever, and that really reflects the fact that we are bottom-up stock pickers. So, yes, we look at the macro outlook and macro indicators, and clearly those are we're in challenging times. But when you look at the companies in India, we still feel very positive about those companies. So even from a regional perspective, and in the regional portfolios that we run, we've maintained our weight towards the Indian market, reflecting our positive view still.
James, hi, morning. But most experts do believe that India is going to just push reforms on the back burner as it goes in election mode. Is it not something that worries you? And also, post the Reserve Bank governor's hawkish tone, this policy?
We share the same view. We don't anticipate any major or meaningful economic reform prior to the elections. I wouldn't say that worries us particularly. Clearly, it's less than ideal. It would be great to see proper reforms being put into place, but we're not, not worried. As I say, I think, on the contrary, what worries us is that the wrong sorts of policies get pushed through in the run-up to the elections, and by that I mean sort of populist policies that are could ultimately prove detrimental to long-term economic growth and put greater pressures on the government balance sheets. And I think the food ordinance is an example of that. So that worries us more than just reforms being put on the back burner.
Right. James, of late we've seen some degree of adjustment in emerging markets. So in last 6 weeks, for your India portfolio, were you a seller, or on a net basis you were an absolute buyer?
On a net basis, we've been a buyer. We haven't overall increased our exposure to India within our regional portfolios, but we have been buying just to maintain our position there. As I say, we felt that when the markets corrected, that was actually, from a valuation perspective, a nice opportunity for us just to add to some of our holdings on weakness. And with the recent rebound in the Indian market, that's obviously become more challenging. So we almost welcomed the correction just a few weeks ago.
So if one of the biggest portfolio investor of Indian equities is bullish on India, it's very heartwarming to get that kind of a tone from you. So my follow-up question is, why are you so bullish on India's story? Because globally everyone has written an obituary for Indian economy, given the way how GDP has contracted, what has happened to currency, and how earnings will pan out for the rest of this year.
Yes, I mean, we take a very long-term view. We are long-term buy and hold stock pickers, essentially. So we're not making a call on the Indian economy over the next 12 months. As I say, I think that the macro environment is challenging, and we don't anticipate any great rebound in growth coming through, certainly not before the elections. So it really isn't a top-down view, and it isn't a short-term view. We're simply looking at the Indian companies relative to companies that we see elsewhere in Asia, and judging those to be better quality companies with more exciting long-term prospects. So relative to companies we find in China, for example, India for us still feels like a better long-term investment destination.
James, what's your view on Indian IT? Because you guys have been a big fan. Of late, we've been seeing a reversal in the trend with the currency, wherein it's been strengthening. Is it time to now profit book then out of IT?
Possibly. I mean, I think you look at the valuations, and they are certainly on the high end in absolute terms and on a relative basis. I think there's probably better value elsewhere. Obviously, Infosys is trading slightly cheaper than TCS. So, I mean, even if it's a case of just looking more at some of the smaller or mid-cap IT services companies where there's better value, perhaps, or switching out of IT services in favor of other sectors, given the valuations, both, I think, would be sensible calls.
That you like out of the mid-cap IT space, and would names like Tech Mahindra or Mindtree be part of the list?
We have two smaller IT services companies in our portfolios. So we own Emphasis and we own CMC. We're happy with both of those holdings. Emphasis, I think, clearly going through a period of change with the HP business in decline. But long term, I think, still a very sound business. And so those are our two picks in that segment of the sector.
You talked about value emerging in a couple of other beaten down pockets, James, and to my mind or to anyone else's, the most beaten down has been the banking pack. Are any of the banking names now throwing an opportunity to perhaps start nibbling in at least?
I think they were a few weeks ago. So we did see sharp corrections in the likes of ICICI and HDFC and others. So that was, I think, a nice opportunity. I remain somewhat sceptical on some of the PSU banks, largely due to the concerns around credit quality deteriorating and the building up of restructured assets there. So even if those look attractive from a valuation perspective, we remain somewhat cautious and continue to favour our private bank holdings like ICICI, like HDFC and others, where we feel credit controls are stronger and we haven't seen the same spike up in non-performing assets.
James, so at the current juncture, if given an option to choose between large cap IT and large cap banks, which way would you lean?
On balance, probably towards the banks at this point. As I say, I think the valuations for the IT services companies are pretty high. I mean, they've done fantastically well. I think TCS is up 50–55% year to date. Emphasis a little less, but still they've had a great run. Now, a lot of that's been driven by the currency boost. So on a relative call, I think that the banks look the more attractive prospect at this point.
Cement still a part of your core portfolio. If Indian economy is contracting, if it is not expanding, cement, which is a proxy to any economy, does poorly.
True, and we have seen some short-term softness in demand for cement across our cement holdings. But as I say, we're long-term investors. We're taking a long-term view, and that demand will bounce back. It will recover. I can't say when exactly. But now is the time to be building up positions in those sorts of companies where the long-term story remains intact. There's no balance sheet pressure. They remain amongst the best quality companies, and valuations have come down to more attractive levels, or had. I mean, again, the cement companies themselves are now rallying back somewhat, partly, I think, on the recent price hikes. But even in the short term, on the point of price hikes, there is still reasonable growth. I mean, demand is soft, so you won't get that much on the volume side, but prices will have been hiked and will continue to drive top-line growth.
BPCL and Videocon, those are two stocks that I just want to bring up for you on your screens, and that's some important news flashing in. BPCL Videocon joint venture has made a huge discovery in Brazil, natural gas and I think light crude, if I'm not mistaken. BPCL is spiking up to the tune of about almost 5.5%. BPCL as well going good, or rather Videocon as well going good. We will get to more details on that in just a bit. But James, just coming back to you, your portfolio doesn't have any of the pharma holdings, or at least the top 10 holdings don't have any pharma names, even though the sector has done so well. Stock specific, yes. But do you not like anything out of the pharma sector?
We do. They may not feature in our top 10 holdings, but we are shareholders in Glaxo, we're shareholders in Sanofi, we more recently have become shareholders in Lupin as well. So we have added over the last few months to our pharmaceutical exposure within our India portfolio. So we're very supportive of the sector. I mean, the challenge, I think, as you point out, they've done very well. It's often a highly rated sector anyhow, but valuations again are the challenge. None of these names are particularly cheap, albeit they're nice defensive plays.
The way you invest, are you bothered about the political volatility? Elections, we've got assembly elections in December, followed by general election hopefully in May. Would you be aligning your portfolio to adjust to the election volatility to the Indian politics?
It's not really the way we invest. We're very, I guess, purist in a way in terms of just focusing on the companies and trying to sort of, to an extent, ignore the politics. Having said that, for a long time we have positioned our portfolio or favoured companies perhaps that have less political links or political or regulatory oversight. Because we do see that as a risk. It does introduce volatility and uncertainty. So if you were to look across our India portfolio, we have clearly some companies there that are dependent on sort of politics and regulatory oversight, but it's in the minority.
James, what about consumer stocks, the likes of ITC, Unilever, Godrej Consumer, or for that matter, Nestle?
Yes, I mean, not dissimilar perhaps to the pharmaceutical sector that we just spoke about. Some great companies there, all of those that you mentioned, very high quality businesses, but valuation-wise, that is priced in, very much so, and they've had a very good run. I mean, we saw ITC, I think, correct a little bit a few weeks back, but has now rallied back again. I think is still over 30 times forward earnings. Unilever, Hindustan Unilever, obviously got a big boost from the voluntary offer that the parent company made and has stayed at fairly elevated levels. So for us, the sorts of companies we like to invest in and hold for the long term, but we just have to sort of hold back our enthusiasm, shall we say, because of those valuations, and that's reflected in how we weight the different names within the portfolio.
All right, James, appreciate your time, and so glad you could accommodate this interview request.
Pleasure.
Well, that was Aberdeen Asset Management, one of the biggest portfolio investors in Indian equities. They have direct investments worth to the tune of about $9 billion, and they clearly are not panicking. In fact, you heard the house view. They have been net buyers in Indian equities in the month of September, and they've used September volatility to their advantage to really load more banks and add some more IT stocks. Their contra call clearly is cement, and they believe that cement sector currently is offering deep value and it should rebound going forward.